Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of understanding systemic risk, what it means for the global economy. Measuring systemic risk. In a world where financial markets are more intertwined than ever, measuring systemic risk is crucial. It's like having a smoke detector that alerts us before the fire spreads. Knowing how to measure this risk effectively can mean the difference between maintaining stability and facing a financial meltdown. This section dives into how stress testing and specific risk metrics play pivotal roles in identifying and managing systemic risk. Stress testing. The importance in identifying systemic risk. Stress tests are akin to financial fire drills. They prepare institutions for potential market turbulence by simulating adverse economic scenarios. Why are they essential? Because they lay bare the weaknesses that typical market conditions might mask. By examining how a bank or financial system would fare under severe strains, like a sharp drop in asset prices, stress tests provide insights into potential vulnerabilities. These scenarios aren't just hypothetical exercises. They help regulators and institutions identify which financial entities might struggle to weather economic storms. It's about readiness. Stress tests highlight where capital cushions might be too thin or where dependencies could magnify trouble. This proactive approach ensures that financial systems are better equipped to handle real-world crises. Incorporating a variety of potential risks in these tests, from geopolitical tensions to rapid technological shifts, helps paint a comprehensive picture. This isn't just about anticipating the obvious. It's about understanding how interconnected factors could escalate systemic risk, allowing institutions to shore up defenses before threats become reality. Risk metrics and indicators. Measuring systemic risk. Monitoring systemic risk isn't just about looking into a crystal ball, it's about using concrete data. Several metrics and indicators act as the compass guiding financial institutions through uncertain waters. Here's how they can help. Value at risk, VAR. This metric provides an estimate of potential losses in portfolio value over a defined period for a given confidence interval, offering a snapshot of market risk exposure. Conditional value at risk, CVAR. Similar to VAR, CVAR estimates the expected losses exceeded by the VAR, highlighting worst-case scenarios and providing deeper insights into tail risk. Leverage ratio. This simple measure of the ratio of a bank's capital to its total assets helps assess financial stability. A high leverage ratio can signal overexposure, making the entity more vulnerable to market shifts. Liquidity coverage ratio, LCR. This ratio gauges an institution's ability to withstand short-term liquidity disruptions. By ensuring there are enough high-quality liquid assets to cover net cash outflows over a 30-day period, LCR safeguards against quick market swings. Network analysis. With financial systems behaving like interconnected networks, mapping out these connections helps pinpoint potential points of failure or stress. These metrics aren't silver bullets, they're tools. By weaving these indicators into regular assessments, institutions can monitor fluctuations and spot trends that might signal brewing trouble. Information gleaned from these tools can guide policymakers and financial leaders in crafting strategies that bolster stability and reduce the chances of systemic shocks. Mitigating systemic risk. Addressing systemic risk is like fixing a leaky boat. You need the right tools and strategies to support the boat and keep it afloat. In the financial world, regulatory frameworks and crisis management mechanisms are these tools. Here's how they work. Regulatory frameworks. Analyze the role of regulatory frameworks like Dodd-Frank and Basel III in addressing systemic risk. Regulatory frameworks are the guardrails of our financial system, and they play a critical role in combating systemic risk. Think of regulations like Dodd-Frank and Basel III as safety nets, designed to catch potential issues before they spiral out of control. Dodd-Frank Act. Enacted after the 2008 financial crisis, Dodd-Frank aims to prevent another meltdown. It's like a rulebook that banks must follow, ensuring they hold enough capital to weather economic storms. The act also established the Consumer Financial Protection Bureau, which acts as a watchdog for consumers navigating the financial seas. Basel III. This international framework sets standards for bank capital adequacy, stress testing, and liquidity. Imagine building a fortress where banks are required to have thicker walls, more capital, to withstand financial earthquakes. Basel III encourages global banks to maintain robustness, reducing the chances that a single failure can trigger a widespread crisis. These frameworks ensure financial institutions maintain a buffer, limiting the domino effects seen in past crises. By enforcing strict capital requirements and enhancing oversight, they aim to keep potential risks in check before they escalate. Crisis management mechanisms describe how governments and central banks can manage systemic risk during crises. When financial storms hit, crisis management mechanisms are the lifeboats. Governments and central banks have strategies to steer through rough seas and stabilize the economy. Central bank interventions. When markets waver, central banks wield powerful tools like interest rate adjustments and quantitative easing. Lowering interest rates can encourage borrowing and investment, acting as a defibrillator to jolt an economy back to life. Quantitative easing, on the other hand, involves central banks purchasing securities to inject liquidity into the market, much like a transfusion to keep financial blood flowing. Government support programs. During crises, governments often introduce fiscal stimulus measures, such as bailouts or relief packages. These are lifelines thrown to sectors and industries struggling to stay afloat. For example, during the 2008 financial crisis, governments worldwide launched massive bailout programs to prop up failing banks and restore confidence. Regulatory adjustments. Sometimes, rules need tweaking. Regulators might temporarily ease certain requirements to allow financial institutions breathing room during crises. This flexibility can prevent panic selling or a mass credit freeze, providing a cushion against immediate financial stress. In essence, these mechanisms act as shock absorbers for the financial system, designed to mitigate the impact of unforeseen economic tremors. Together, regulatory frameworks and crisis management mechanisms form a resilient defense, aiming to prevent localized problems from evolving into global crises. Future of systemic risk. In the ever-changing financial world, systemic risk is like a storm cloud on the horizon. As our systems grow complex, fueled by tech advances and global connections, how we face these risks must evolve. From the rise of fintech to regulation shifts, let's see how these factors could reshape the future of systemic risk. Impact of technology and innovation. Technology is changing the game. Fintech, blockchain, and AI aren't just buzzwords. They're reshaping finance and introducing new risks. Fintech. These innovative companies push the traditional banking boundaries. They're fast and efficient, but can they handle a financial crisis? If they're not regulated like banks, what happens when things go wrong? Think about digital payment platforms. They move money at lightning speed. But if they fail, millions could be stranded at once. Blockchain. Touted for security, blockchain is not immune to systemic risk. Imagine a world where decentralized finance crashes. Trust in blockchain could vanish overnight, shaking markets that have come to rely on this technology. Its openness and security might just be its own Achilles heel. Artificial intelligence. AI is revolutionizing data analysis and decision-making. Yet, it's not foolproof. Algorithmic errors or even manipulation can lead to market panic. AI's ability to make rapid decisions could spread errors quickly, much like a virus in a network. As these technologies challenge old systems, they also highlight the need for new ways to understand and manage risk. Evolving regulatory landscape. Regulation must keep pace with innovation. As new risks emerge, regulations must adapt to maintain stability. Agile regulation. The future calls for nimble regulatory systems. We need rules that keep pace with tech advances, ensuring they curb risks rather than stifle innovation. Technology won't wait, neither should our regulations. International cooperation. Systemic risk knows no borders. As finance becomes more global, international collaboration is vital. Regulators must share information and strategies to tackle these interconnected risks. Imagine a network of financial guardians working together, each a part of a global shield. Data privacy and security. With data as a core commodity, protecting it is crucial. Regulations must ensure that personal data is secure, and that market players handle it responsibly. A breach isn't just a minor hiccup, it could be the spark that lights a systemic fire. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.